It's never been more important to be deeply diversified, not only across asset class, across geography, across manager, but also by introducing alternative assets, private assets, hard assets like metals, these non-correlated assets that are going to provide those cushion for volatile times.
Welcome to Rise Up, where we take a look at the biggest stories each week and really help you break them down so that we can understand how to grow and protect your portfolio. There's a lot going on this week. Markets are up, markets are down. A lot of people are feeling uncertain, but that's our goal here at Rise Up, is to bring our mission of some of the brightest minds in wealth management as a fiduciary, always doing what's right for clients, and help you navigate through the markets on a weekly basis. So I'm here with my co-host, Joe Duran.
Hi, Terri, and nice to see you. Here right before Easter, no market open tomorrow on Friday, Good Friday. And to all of our friends who celebrated Passover last weekend, I think it was. Hopefully everyone's going to recharge and relax with a closed market. It certainly has been incredibly volatile every day. So maybe some chocolate will get everyone to calm down a little.
That's right. I hope that, tomorrow people can take some time just to breathe, calm down, maybe even listen to our show if you have time, and make sure that they can help make better decisions the following week when the market starts up again. And maybe you'll have time this weekend. If you go out to Wealthion.com, you can do a free portfolio review just to kind of calm yourself. And then next week, make an action plan to call one of our advisors and get the help and the guidance that you need. So we also have two great wealth managers with us. We have Peter Boockvar, who's been with us just about every week, a CFA, just one of the very best to understand what's going on in the markets. And then we have actually a new person with us today, Jon Betlow, who's also a CFP. He's with Bleakley Financial Group. He's a wealth manager, works with clients on a day-to-day basis with all of these changes. Welcome, Jon and Peter.
Great. Thank you.
It's great to see you, gents. And Terri, as you know, we love to include both the investment professionalism as well as the perspective of a financial planner. It's fairly unique. We've all both been on TV a lot, and it always focuses on just investing. We think it's important to think about your financial life as a whole and think about how all of these situations in the market impact your day-to-day decisions as you live your life. So it's obviously an incredibly crazy week, Terri, again, in the markets after a very nice recovery for a few days. We're back to testing in some of the indexes, headed back to test the old lows again. So kind of disappointing.
That's right. That's why I think it's so important to have both, to have all of the numbers, the investment numbers, the CFAs, and what's going on in the portfolio. But it's also important to recognize how we actually respond to those more psychologically. And there's been a lot going on. So let's just talk a little bit about the big three this week. The market volatility continued this week. Huge market swings across the board. New news about tariffs, what the economy's doing. And then let's take a look at the most recent numbers. U.S. stocks were mixed on Thursday. The benchmark S&P rose about 0.1%. The NASDAQ composite slipped 0.1%. And then just recently today, the Dow Jones Industrial Average dropped more than 500 points. And NVIDIA, one of the stars, dropped another 3%. And so
that follows, Terri, as you know, yesterday was quite a rough day. We had NVIDIA kind of led the charge, big drop yesterday. Today was led by United Health. So I think that there's three big things that happened this week that everyone needs to think about. Number one, we are in the heart of earnings season, and we've had good and bad news. The financial stocks reported at the end of last week and the beginning of this week, really cautioning, good results, but cautioning about what's coming, especially with IPOs and investment banking activity there, a little slow. But no signs yet that there's been a slowdown in the economy. We were in pretty good shape before, but they clearly are all warning about something in the future. Then obviously we had NVIDIA yesterday warning about some challenges with earnings, especially as it comes to the trade challenges we've had. But then today was really United Health, big 22% drop. That really drove the Dow down today. And it was more isolated. The rest of the market seemed to be all right. So we have the trade tensions, obviously NVIDIA, $5.5 billion revenue impact. And there, I believe Wang, the CEO, is actually in China as we speak, trying to negotiate and figure out how to not have as big an impact on its revenue. And then the third, really kind of unsavory here, the Fed obviously spoke yesterday. That was a big trigger for the market going down. Basically, Powell saying that really any drop in interest rates is off the table until we see the impact of these tariffs. But more importantly, we have a tit for tat going on social media between the president and Jerome Powell, who it's very clear he's not looking to have extend beyond his, I believe it's May of next year, Peter, that he's in his seat. And the president does not have the authority to remove him. I think the president would love for him to resign a little sooner, but I think he was quite vocal in his speech yesterday. He really values the independence of the Fed, and I think we all value the independence of the Fed. So I think for all the markets, we don't need to add another thing to worry about. And frankly, regardless of how we think about how he handled coming out of COVID and how long he held low interest rates, the reality is a new person will bring in a new set of questions, which is not what we need right now, I don't think. Peter, any thoughts on those three big things? I know, Terry, we've got our big three, but I feel like it's just been a roller coaster every day with something new.
Yeah, I think you highlighted a lot of the important points. And hi, Joe. Hope you're well.
I am great. Yeah.
NVIDIA, something that we've talked about now for the last month is even before the tariffs, the market leadership was beginning to splinter. When I say market leadership, we can use the cliche Mag 7 at this point, where at the peak made up 35% of the S&P, and we know NVIDIA was a key part of that group. So NVIDIA faltering, Tesla has faltered, Apple didn't get the Apple Intelligence upgrade cycle that people hoped for. People are worried now about Google's search business and competition. So these are the chinks in the armor that the stock market has experienced. And then, of course, you layer on tariffs and wondering where all this goes. And with the Fed, you're right, Jay Powell's got about a year left, 13 months. And right now, his thought, his legacy in his mind is, after losing the fight on inflation and calling it transitory, and then being able to recapture it with the lower rates that we've seen over the last couple of months, the last thing he wants to see is losing that battle again and seeing inflation flare up again. Even if it's tariffs, even if it's not something that he's going to be able to control, I think he's going to want to do his part in trying to deal with the secondary potential effects of tariffs. And he's fought this battle with Trump once before. It was 2018, 2019 when Trump was beating him up. So this is nothing new to Powell. And I think Powell is somewhat hardened to it, somewhat desensitized to it, and again, is more focused on keeping inflation in check rather than satisfying what the president wants.
Yeah.
That's right. I think, President Trump is going back to his days of "you're fired," right? When the apprentice, he's practicing those terms, but Powell says, not lawfully, can't be done. So, John, let's talk about clients now, because they're the ones that are really at the center of all this. And I know you do 360 life planning, which I'd love to hear from you, your perspective on that. But what are you giving your clients right now in terms of advice and long-term planning?
That's a great question, Terry. Holistically, what we try to answer are two main questions that our clients are asking. Number one, am I going to make it? And two, do I have any financial pitfalls that could derail me along the way? To the second question, we want to make sure that our clients are insured from a defensive financial planning perspective, that they have their estate planning in order, their documents, their insurance, etc. And then, am I going to make it? Well, during these times of volatility, clients are asking, what are we doing about these times? I answer that really two ways. It's not what we're doing so much, and we are doing things, but it's really what we've done up until now to prepare for these moments, because volatility is not new. Right? We see 10% corrections in the market every 2 years. We see 20% corrections in the market every 5 to 6 years. So clients' portfolios should be prepared for these gyrations. And I think, to Peter's point about the splintering of this Mag 7 and this sort of large cap growth rollout here that we're seeing, this roll off, clients are more open to really buying in and owning these more deeply diversified portfolios. So that's really the advice we're giving. It's never been more important to be deeply diversified, not only across asset class, across geography, across manager, but also by introducing alternative assets, private assets, hard assets like metals, these non-correlated assets that are going to provide those cushion for volatile times. And as long as clients have their liquidity planning met for the next several years, it matters a little less, although it makes us uneasy as well when we see market volatility. It matters a little less what happens in the interim if we're not looking to sell those assets that are going up and down to meet liquidity needs today.
John, we had an earthquake here in California, in Southern California, just a couple of days ago. And planning is kind of like earthquake insurance. You don't think about it unless there's an earthquake. And then the first thing you ask is, do I have it? Have we got an emergency kit in place? Financial planning is kind of the same thing. If you have a plan, you can't do anything about the circumstances, but you can go back to your plan and say, look, we have no idea what the markets might do on any given day, but we know that we have levers we can control. We can control our spending. We can control when we retire. We can control how much risk we take in our portfolio. Yeah. So these are all, I think a good planner, what they're doing is helping you to get back behind the cockpit and say, look, you can't do anything about the weather, but we can choose where we take this airplane. And I think it's very helpful to just think about plans in that way, that it's just a system to make good decisions to get through the turbulence.
Absolutely. And it's not that we're not doing anything. To the point is, when markets move, we are rebalancing. We are acting with discipline. We are, buying low, we're selling high. And those incremental actions along the way and being tax aware and owning the right asset in the right account all add up to great value delivered for the client.
Yeah, I think a plan really helps you proactively buy low and sell high, right? Instead of reacting in a difficult time like this. But let's go on to the second topic now of the big three. And this is a usual topic. It's really the latest on the tariffs, the daily news drips and what's going on. But really the headline this week has been the circles around China and Italy as it became the first EU country to meet with the US to discuss tariffs. So Peter, what kind of deal could be done with Italy right now? And what do you think this has an impact on the markets?
Well, that's really the important question is what are the deals going to look like, whether it's Italy or China or just broadly with our trading partners? What's the goal? Is it to lower global tariff rates? Well, that would be a good thing. Is it just to raise money? Is it to encourage companies to reshore to the US? It's not particularly clear. And because it's not clear, I'm not sure what a deal will look like. The interesting thing with Italy is that Brussels wants to negotiate with Trump as a bloc, whereas Meloni here is most focused right now on getting a good deal for Italy. So it'll be interesting to see how that dynamic works out. The China discussion is the most important because we import $440 billion worth of stuff from them. And while their manufacturers that sell that stuff to us are going to get negatively impacted by the very high tariffs, there are a lot of US businesses that rely on these imports as both intermediate term goods and finished product that they sell here that they can't quickly find alternatives to. So every day that goes by, more and more businesses are at risk. So it is really crucial as soon as possible for there to be some deal that can lower the temperature, some deal that can lower the tariffs and keep American businesses alive that rely on China as a trading partner. So each day, we don't know where it's going to go. We hope there's some resolution, but really time is of the essence right now.
And I think what we've seen from the Chinese in particular, they want to come to the table, but they will not do it under duress. Like I've been to Asia many times. There's a thing called FACE, which is your integrity and how you're perceived. And it really matters. if they look like they're acquiescing and coming on bended knee, that is never, ever going to happen with the Chinese government. And so
Absolutely.
we have to be able to give them a face-saving way to come to the table. Escalating and escalating. I think we're at 245% on certain items now. It does nothing because it's not helpful to giving these countries with politicians who also want to get elected to represent their countries and not lose face or dignity in front of their own voters. So again, I do think it's a little disappointing that when Japan came and said, we'll take our tariffs to zero, that didn't seem to be enough. And it's added this question now for all countries, well, what is the deal that the administration really wants? And I agree with you, Peter. China's the big one because it's just a tax on businesses here in the US, and it indirectly affects manufacturing, but it absolutely directly affects profit margins and costs for every business that uses, as you said, hundreds of billions of assets that are being brought to the US as part of the manufacturing. Even made in US products like Tesla are having problems sourcing product because of the cost. I believe the auto taxi got deferred because of the cost of tariffs and the unpredictability of what it's going to cost to build those cars here in the US. So the interconnectedness of everything makes this very, very unpredictable. And I agree, Peter, this is a temperature game. Like, we have to remember, everybody has their own country to satisfy. And while they all want to make a deal, they're not going to do it if it makes them look weak.
Right. This is art of the deal versus the art of war, which we know China knows well in the Sun Tzu book. And it's either someone has to blink or they're going to have to shake hands both at the same time, because if they don't, there's mutually assured destruction here. And none of us want to see that, of course.
Yeah, I think one of the things we think it might, not necessarily help the U.S. economy, but this really has the possibility of destabilizing the entire world economy. And so, we're looking into many of these issues right now.
And also, Terri, the good news is we have priced in already a lot of this uncertainty globally. Mm-hmm. It's in the stock prices already. And I just think there's a very interesting stat that I think is worth sharing on this subject. Bank of America does a survey, I believe it's every quarter, of all the fund managers, the mutual fund people who are picking individual stocks. And I don't think I've ever seen it this high. But, well, first, 80% of them view the global tariffs, the trade war, as the biggest single issue in front of us. That's not a surprise. What was a surprise to me is 90% of professional money managers expect global stagflation as a consequence. And that is surely not good for any investor. And again, the good news is some of that has been priced in. We just don't know how much, because we don't know for how long. We don't know the magnitude. So we don't have a sense of duration nor the sense of impact on any of these companies. Now, companies that are protected, like Netflix today, which announced after the close, they are very close to old highs, which is what Jon was talking about, the importance of understanding that this might be an environment where stock picking becomes more important, having the right asset class becomes more important, and certainly for the first time in a while, investing in other countries has a real impact on diversification, on reducing the risk of your entire portfolio. And so I think gold hitting new highs, like you have a lot of different asset classes that are not going down in sync, because not everyone's going to get impacted to the same degree. So right now, firms like Netflix are probably overvalued because it's the one place that you can go, well, I don't think they're going to get impacted by either a recession or a global trade war.
Yeah, Joe, when we use the term like stagflation, I think it's important for our viewers to just understand, because, we haven't really been through that for quite a long time here in the U.S., but there certainly is risk of that. And that's high inflation, stagnant or declining growth, and then rising unemployment. And that if that's happening, we're moving into stagflation, and something we all are concerned about. But let's go to the third of the big three. And that really leads us to NVIDIA and what's going on there. So, NVIDIA took a major hit this week when it revealed it would incur a $5.5 billion in costs due to canceled orders on its H2O chip after the U.S. put restrictions on its selling to China. The company's stock dropped 6.9% on the news, and at least one bank, Morgan Stanley, trimmed its revenue projects for the year for NVIDIA. So, Peter, is NVIDIA the canary in the coal mine here? Are we just starting to see the effects?
Well, this is an interesting story because these chips were specifically made, blessed by the US government, to sell to China. So they were specifically allocated to sell to them. And then sort of the last minute, the US government pulled that license. That's why NVIDIA is actually writing this off, because there's no one else they can sell these Chinese custom chips to. So I think it just further heightens this sort of technology battle. And I just think you still have to wonder that the US continues to make these attempts to suppress China's technological advancements. And is it working, or is it just stimulating China's desire to develop this all themselves? And that fast forward the clock a couple of years, and China's not going to need us at all for US technology. And US technology companies have the potential of not only losing China as a customer, but we're creating a big competitor also to US technology. So there's this real fine line of wanting to delay their progress, but at the same time shooting ourselves in the foot, because we know that necessity is the mother of invention, and China has really advanced rather quickly over the last couple of years in their technological advancements on the chip side and the software side, and certainly the AI side.
I think this plays, it's the same story we could say, not just about innovation, but trade. The Chinese president was with Vietnam. And what do we think they're talking about? They're probably looking to offload a bunch of their production and selling and product sales to Vietnam. And I'm sure he'll go to Europe next. If we step out of the global stage, it's not like the rest of the world is just going to say, well, we won't do anything anymore. They're going to try to manufacture and create trade deals with each other. And I think it has always been in our advantage that we have led those discussions. Mm-hmm. And again, I agree with you completely on the innovation challenge. It's a war on AI and technology, and it's not stopping. It might slow down temporarily, but we would rather have them be reliant on us to some degree, I think, because it does give us some negotiating power. So it's a very interesting dilemma that we're facing here.
And Jon, I'd be interested to hear your thoughts on this, because I know you have a balanced portfolio for your clients, but if your client has NVIDIA, are you telling them to sell or to buy, or what is your plan?
Yeah, so I think we're very sensitive to highly concentrated positions, and we do what we can to minimize and mitigate risk there by using single stock strategies. We certainly love buying dips. Any change in trade policy, and NVIDIA could shoot up another 20 or 30% in a very short period of time. But individual stock selection gets tricky, as Peter can attest to. And I think, again, just to my earlier point, it's never been more important to be fully diversified. Understand what your tax liability is also of selling those positions. People want to sell when things get bad. Typically, catching the bottom, catching the top, it's a fool's errand in a way. So as long as it's part of their core portfolio, and they don't need the asset, or they don't need the cash today, and selling that asset, we don't see any reason to make any drastic changes unless something has changed dramatically in their plan.
That's great advice. So no quick reactions here on NVIDIA at this time. So let's turn to our big topic at this point, and then the three big questions that we're getting from our viewers. So our big topic this week is the Fed again. And it's really based on a comment by one of our guests on Wealthion that spurred the idea. And you can imagine, our chairman, Jerome Powell, came out and said that the Fed has a tough decision between controlling inflation and spurring economic growth. Many, including macro investor Jim Bianco, took that as proof that the Fed won't be coming to the rescue this year. Earlier this week, in an interview with Maggie Lake, he told Wealthion viewers that the days of being able to ride the indexes and the Mag 7 are over, and everyone needs a portfolio manager. That, with volatility and the whiplash that we're feeling, you need someone watching that is really working for you full time as a wealth manager. Since a big part of our mission is doing that, we thought it'd be a good idea to answer our viewers' questions about being a self-directed investor and what moving some or all of our portfolio would look like, the benefits, and the different kinds of wealth managers. So our first question is from Thomas from Cincinnati, Ohio, who is a self-directed investor and says he would love to have someone help him, but he's concerned about the fees and the costs and that eating into his profits. John, you're a wealth manager. I'm sure you get questions about fees and value delivered. What's your response to our Thomas in Cincinnati?
So it's a great question from Thomas. Look, if we weren't confident that we could more than cover the fees and costs associated with our advisory practice, it would be tough to keep the lights on. With that said, what's nice for our clients to know is that there's someone at the wheel 24/7, right? Most of our clients who were do-it-yourselfers and then turn the reins over are smart enough, have enough resources to do it themselves, but they just don't have the time, or the interest, or maybe even the acumen any longer. The best anecdote I can tell is when I graduated from college, I did my own tax return. It was fairly simple. I didn't make much money. I didn't want to pay an accountant, and I had plenty of free time. But as I, got older, had a family, I found that my accounting, accuracy was wavery at best, and I felt more comfortable having someone else handle that for me. The same is true on the financial planning side. But you're not just paying for the wealth management. You're paying for a plan, right? Knowing that there's someone who's going to come with tax advice, estate planning, insurance, really that one point of contact that can be a reliable source from someone who has a fiduciary responsibility to you and your family.
I would add, Terri, this is a great question that always comes up whenever we're doing any public speaking. And I'd say you're paying for two things. You can pay for two things with a wealth manager. The first is your portfolio management decisions. You can earn back 1% literally by just having a professional advisor who rebalances your account and does nothing more than that twice a year. Just by ensuring, when we say buy high and sell low, what that means is when the markets have dropped and it's down, your last inclination will be to buy stocks. But a professional advisor doing nothing about guessing where the market is going, just having the discipline of rebalancing you when you get out of your target allocation means you're buying low. And the reverse is true. If at the end of last year, after a 2-year run in the S&P 500, you had a professional advisor who managed your investments and only your investments, and they rebalanced you, they would have sold stocks and purchased bonds because you were out of balance. You'd gone from 50-50 to 60-40 because your stocks had gone up so much. So the reality is, just on that one thing, having somebody, because I know how busy we all are with our lives, you typically just don't get around to thinking of doing it.
Doesn't
and then,
happen.
more importantly, actually doing it. So that's the one easy peasy thing that pays for what, again, it's not a small fee, but just that alone is probably worth it. The second element, obviously, tax overlay, being diversified, making sure you have asset classes that protect you in down markets. That's a hard thing to do. You need somebody who's full-time job and has the training to do that. So that's investments. On planning, it's indispensable because you will not fail because you underperform the market. You will fail because you make a financial choice about your life that has implications that completely decimate your financial future. Whether you retire too soon or you're spending too much in retirement or did not save enough and you thought, well, $3 million is enough, but you're spending $300,000 a month and you retire at 62, it's going to be really hard to make the math work. And I always think a great planner is a purveyor of truth. They're bringing honesty and accountability to the choices that you're going to make and hopefully helping to optimize the way you make those choices. So obviously I've a biased view because I've been doing this my entire career, but I don't know the advisor that as fiduciaries, their entire career is based on keeping those clients happy. And there's nothing more important than that. There is no commission. So if you're not happy, if they're not delivering value, you fire them. You simply fire them and you stop paying them. But if nothing else, to get your portfolio allocated, to build that plan, and then they have to earn it every day. And if they don't earn it, you just stop paying them. You fire them. That's why the fee structure is so aligned. Why fiduciaries are really, if you are going to have a wealth manager, make sure they're fiduciary and make sure you're paying them a fee that allows you to stop service when you're not happy.
Yeah, and if you're paying an advisor a fee during this time and you have not heard from your advisor in terms of how you're doing and, coaching you on what steps you could be taking at this time, or at least at a minimum rebalancing, you should really fire your advisor at this point. You really should. I mean, you need the guidance, you need the help. Like Jon, for example, he's excellent at this. And Jon, I have to admit, you admitted you did your own taxes. So I'm pretty impressed. We're going to have to talk about that afterwards. Were you 18 or 19 at the time?
Oh yeah, I was probably 21 or 22. With it was easy. Not a lot of income and a lot of more free time. So it was a good investment for me then. Not so much now.
Yeah, I have 3 adult children, and I just finished all of their taxes in the last week with them. I'm trying to teach them to fish. They have no interest in it whatsoever, but I certainly remember those days. So, okay, let's go on to our second question now. Zachary from Manchester, Vermont. And this is a common story happening right now. I have a very close friend like Zachary. She's 61. She's ready to retire. She set her date May 1st. And she's wondering, should I retire right now? And Zachary feels the same way. I'm getting ready to retire. I'm asking myself, is this really a safe time to retire with the market so shaky that we have to depend on this income? Joe, what would you share with Zachary or my friend in this scenario?
In any financial plan, the biggest impact for almost every human being is when they choose to stop working.
Yeah.
It allows you to override any decline. It allows you to override almost anything. The impact on a financial plan, if you just extend the time working and earning an income, wildly changes your likelihood of not running out of money, which is everyone's biggest concern. So I can just tell you, as someone who's been doing this for decades, if there's ever a question and you like your work and it's not leading you to an early grave, that's the easy lever. And even if it's stepping back and doing consulting, because retirement is very expensive. You assume, well, I'll stop working, I'll keep spending them out. But guess what? You're going to play more golf. You're going to travel more. You're going to spend money. So work is not just generating income and deferring living on your savings. It's also spending less. So I would say if there's a question and you don't mind your job, stay at it or stay on as a consultant. Like, keep the income stream because it'll keep you busy. And by the way, keeps you young. Having your brain engaged. And if you are going to retire, find something to keep your brain engaged and keep your life meaningful and young, because it is the most aging thing that happens if people retire and no longer have a purpose or a mission. So I'd say the 3 steps. Number 1, make sure you can afford it. Number 2, if you can do a variation where you can stay engaged, great. And number 3, when you step out of retirement, be stepping into something. Make sure that you're still intellectually stimulated so that you stay young and vibrant for your friends and your family and everyone else.
Joe, I couldn't agree with you more. I think some of the most successful plans that we see for clients are those that have the semi-retirement phase, where they go into consulting. If they're an attorney, they work off counsel at their firm for 2 or 3 years. They serve on a board. Any incremental income, it's a double benefit. To your point, they're earning and not drawing down on their assets, and the impact that has on the longevity of their successful plan it's immeasurable. It's really remarkable when you look at it on screen. And we can, a good plan can actively toggle these what if scenarios. And those are the sort of discussions that we, engage with clients every day, and we, suggest that people, have with their planner.
Yeah, I think my friend that I mentioned earlier, she's really considering taking on a part-time job after she retires. Not so much because she needs the money, but she wants to keep working and keep actively engaged, but not necessarily in her current field of portfolio management. So that makes sense. All right, our last question, it comes from Bonnie Steinberg, and she sent it to us by email. And she hears this word fiduciary quite a bit. And, she's wondering what is a fiduciary and how does that work with financial advisors?
Terri, you should answer that question since you are
That's
the
right.
chair-elect of the CFP board globally, and
That's
there's
right.
no one better qualified. So I think that's a good one for you to take on.
Well, thank you. I appreciate that. But a fiduciary just really means that you're always doing what's right for your clients, but there are specific standards that you have to meet. You can't just post that out on your sign and say, I do what's best for my clients, and just leave it at that. So oftentimes, not exclusively, but oftentimes a financial advisor who is registered with an RIA, which is a registered investment advisor, is generally a fiduciary, meaning they have to be able to prove that they're doing what's best for the client. Now, you might be asking, Bonnie, well, what's the difference? Well, there's another term called suitability, which just means you're not doing any harm. So suitability basically means no harm. Fiduciary means we're doing the very best for clients. And that's how I try to remember it. And when I think about my own particular family situation, I would want to make sure that I'm always doing what's best for the client, not that I'm not doing something that's going to harm someone. So keeping that in mind, I want to make sure that we look at the compliance with this SEC and FINRA. There's somewhere that you can go to called FINRA's broker check, and it's the SEC's investment advisor public disclosure system. So if you want to look at your advisor, go to FINRA's broker check and make sure that we do checks on your current advisor. The other thing is you want to keep in track of the fee structure. Do you have fee only versus commission based? And fee only advisors charge a flat fee based generally on assets under management, and they avoid commissions, which are particular, based on product or based on trades. And there's really no hidden fees or kickbacks to keep in mind. And then there's conflict of interest disclosures, which is if I have some type of conflict of interest, I have to disclose that. If I'm getting certain fees from certain funds, I have to disclose that as a fiduciary versus what I talked about, suitability. And oftentimes, for the most part, fiduciaries will offer holistic financial planning, tax planning, estate planning, insurance planning, and retirement income strategies based on your goals, not particular what products you particularly need. So hopefully that helps. Jon, anything you want to add to that?
I think that's it. I mean, I think the CFP, Terri, congratulations on your election, is really the gold standard for the industry. Having a fiduciary duty to the clients and holding themselves to a high ethical standards like we do as CFPs is part and parcel with what we do every day.
And the SEC doesn't approve, but it does regulate everyone. You do go through audits. They do confirm that you're doing things the right way. And as you said, you can go to broker check, and anything your advisor has done that might, whether it's complaints or concerns, whether they've done anything unethical, that's going to show up in broker checks. That's quite useful. Terri, I think we've gone really long today. We've covered a lot of ground.
Yes, we have.
I know next week's going to be more of the same, but hopefully everyone's going to be in a chocolate coma on Sunday.
Yeah, why don't you guys talk about the things that you're going to be looking for next week?
Well, I'm going to be looking for an amazing time with my wife because I'm going to Spain with some colleagues to visit Madrid and Sevilla. So I'm going to be looking for a nice glass of Rioja, and I'm going to be spending my ever-declining dollar in Spain because sadly the dollar keeps going down. I'm going to be looking at interest rates on the dollar, which really is a mark of whether the U.S. still has people's confidence. I am not in love with the fact that the dollar's going down and interest rates are going up, especially with the amount of debt that we've got on our balance sheet. So that's what I'll be looking at casually because I'll be having more fun enjoying my friends and my beautiful wife. So.
Well, that sounds perfect. And I know you've got a volleyball game to go to. Your daughter's playing volleyball. So I want to just thank Jon and Peter for being here today. This was a great show. I hope our viewers saw what they can do and take action to protect and grow their portfolio. Thank you for joining us here at Rise Up. Again, go to wealthion.com for free portfolio review, and make sure that you join us again next week. Send in your questions, send in your comments. Grateful to have you here, and have a wonderful 3-day weekend celebrating the holiday.